What I wanted to talk about now is product market fit. So this is a topic that I've spent essentially my whole career thinking deeply about, working on, uh, trying to figure out how to do it better. And my goal today is to really share with you everything that I've learned and that I wish I knew when I was at the point in my career where career or entrepreneurial journey that all of you guys are now. And so we'll talk through a bunch of different scenarios and lead with the 5 pillars of Web3 product market fit. One of the things that I've observed is that there turns out that there's a lot in common between playing poker and achieving product market fit. Actually, any poker players on our team? Okay, so you guys will know this better than me. I would definitely put myself way on the amateur side of things. But when you show up to a poker game, what do? You look around the table, you're assessing the other players, trying to figure out their strategies, their tells, their approach to the game. You're collecting data, you're counting cards to figure out where in the deck you are. And when you're dealt a strong hand, you have this huge increase in optionality in your game, right? You can take things in the direction that you want. You can bet big, you can bluff, you can pass, you can do all kinds of things with the goal of driving the optimal outcome for the strategy that you're running. And achieving product market fit is exactly the same, right? In that if you can navigate your way there in a startup, you have all this optionality at your fingertips. You can choose to grow your company organically. You can raise outside capital as a way to get bigger, better, faster at an increased rate. Maybe you want to run an M&A strategy where you look at companies and products adjacent to what you're building, you acquire them, and by doing that, you expand your product footprint, increase your account control, and get to the next level. But I think the big thing that we're all playing for as entrepreneurs, like the reason why so many of us choose to go down this path that is like so hard and difficult and full of unknowns, is that every single one of us have an opportunity, no matter how small, to build what I call a once in a generation technology franchise company. So think about Amazon, Facebook, Google in the last generation, or maybe OpenAI or SpaceX or Stripe kind of in the current generation. One thing that we are highly confident of at A16Z is that either already or in the very near future, companies in Web3 are starting that are going to really be able to occupy that mantle in this new space, right? Maybe it's one of you, maybe it's someone out there, but the seeds are definitely being planted today in terms of growing crypto and blockchain and Web3 as this massive new software platform. So the opportunity is there, it's palpable, it's wide open, and it's super, super exciting. I think it's helpful to start with a qualitative definition of what is product market fit and what does it look like. And the person who said it first and I think best is Andy Ratcliffe. He was a founding partner at Benchmark Capital, which was arguably the best, most successful venture capital firm in the late Web 1, early Web 2 days. eBay, Uber, and many others are companies where Benchmark was the first investor. And he was also an investor in a company that I did with Mark Andreessen and Ben Horowitz that I'll talk about later, called LoudCloud. And the way that he put it is, first to market seldom matters. Rather, first to product market fit is almost always the long-term winner. Time after time, the winner is the first company to deliver the food the dogs want to eat. Once a company has achieved product market fit, it is extremely difficult to dislodge it, even with a better or less expensive product. So I think that's a nice qualitative definition. If you want to think about it quantitatively, I think that looking at it from a power law perspective is a really good vantage point. So I don't know if any of you have read this book, The Power Law. It's written by Sebastian Mallaby, who was a longtime reporter for The Economist and The Washington Post. And it's probably the best history of venture capital that exists. It's really, really interesting in terms of tracing the origins of the industry back to the 1960s through present day. And one big takeaway of the book is, if you look at all venture funds over all time, returns within a given fund and for firms are not driven by being great at making, lots of 3x, 5x, 10x return bets, but by the few, 100x, 1000x, or in some cases tens of thousands of x return. Those are the investments that really drive and shift the outcome of an entire fund vintage. And it turns out that you can actually apply this exact same thinking down to an individual startup as it relates to product market fit, in that the stronger lock that you get on product market fit will drive exponential results in terms of the value that you can create within your company. So that's why it's like, being able to figure this out, do it well, achieve it, just really dwarfs anything else that you could possibly do and spend your time on. And so over the course of the next 10 weeks, we have a very rich and robust curriculum, and our goal is that we are going to equip you with the skills and a pretty powerful toolbox to do just about anything you need to do in terms of building your company. And the way you can think of it is like you should leave here with a can of rocket fuel that you can pour onto the growth of your company and go exponential. But the hard part, like I said, before when we were talking about the power triangle, this is like easy to say, really hard to do. The problem with product market fit is it's the most one size fits one exercise you can imagine, super, super specific to your product, your technology, your company. And so we can give you lots of ideas, frameworks. We can ask you hard questions for how to do it. But it turns out that navigating that journey is going to be something that that you guys as co-founders and teams are going to do largely on your own. And so, like, if we could wave our magic wand for what you take away from this whole experience, what we want is all of you to emerge from CSX with a clear plan and a set of hypotheses and assumptions that you know how to test and market as a way to increasingly find your way there. In terms of my background, I've spent now over 25 years working at what at the time were frontier technologies, just frontier technology companies. It's just that I've been doing this for so long, these all seem like dated and old now. But so Netscape at the dawn of the commercial internet in the mid-90s, Loud Cloud at the beginning of cloud computing in the late 90s, a company called Ning, which was one of the early social networking and social platforming companies in the mid-2000s, and then most recently Lytro, which was at the intersection of AI and computational photography in 2013. I'll talk more about that one later. But the way that I think back on my career is it's been one long, never-ending quest to find product market fit in different eras of tech. And so again, I'm going to hope that you all can learn from and benefit from the massive amount of scar tissue that I've developed in this space. And so what we'll talk about for the next little bit are, one, what are the 5 pillars of product market fit in Web3, and how are those unique from maybe how some other sectors of tech work? Why finding product market fit in Web3 is not the same as how one would go about doing it in Web2. How will you know, like really at a visceral level, when you're on the cusp of achieving product market fit? The process of managing your own psychology as you're wandering through this journey, and then how do you put some of this theory into practice? Diving right in, 5 pillars of Web3 product market fit. This gentleman was my first CEO, business hero, and crush. He was one of the first, as I was coming up in my career, he was one of the first sitting CEOs that I actually got to meet and talk to. And I, as a kid, I had always loved tech and business. So like meeting a real life CEO was like super exciting and energizing. His name's Bob Metcalf. He was a founder of a company called 3Com and is co-inventor of Ethernet. You guys are all too young to remember this, but like Ethernet was a big, big deal when it came to networking and making lots of computers be able to talk to each other using the same protocol and interoperate well. But maybe more apropos to our conversation today, Bob coined something called Metcalf that became known as Metcalf's Law, and he was really the first deep thinker and articulator of the power of network effects. And he said, quite famously, the value and influence of a network increases at the rate of square of the number of users of the system. Like, so network effects, like, you guys live it, think it, breathe it every day. It's become, in the 30 years since Metcalfe's law came about, it's become just a core part of how ecosystems grow and are built. But when it comes to Web3, right, we have the best network effect primitives and capabilities in the history. And so pillar number one is design self-reinforcing network effects into your protocol or product from day one. What do I mean by this, right? So actually, how many of you are like know that you're doing a token or thinking about doing a token or like might do a token? Just so like probably about 2/3 of the group. So the amazing thing about tokens, and in a couple weeks, our CTO Eddie Lazarin is going to give one of my favorite talks on how to think about designing your protocol and token, right? But for the first time in the history of technology, we can take all the amazing things that software lets you do in terms of creating and building network effects, and you now have a native tool in your network that you can use to drive and incent the behavior of your community, your developers, your users to move and use and take advantage of your network in the best way possible. So, pillar number one, understand what your network effects look like, understand how having a token can improve and accelerate that, and really understand that at a first principles level and lead hard into that. Pillar number two is what I call maximizing your win rate with the best projects in the space. And so this is like particularly important. A lot of you are building networks and infrastructure capabilities, as we heard in the intros today. And the overall community of Web3 is small enough today that at any given time it is actually like quite easy to know who the best, most creative, innovative companies are that are operating in the space. This is something actually we talk about within A16Z at our investment meeting every Monday. We're always looking at this, trying to understand it better, figure out how the landscape has changed, like who are the new entrants, who are people that maybe were killing it before but seem to have lost momentum. And one great way to navigate product market fit is if you can know who those companies are relevant to what you're building and work hard to win them as customers or users or developers, get them to deploy on your infrastructure. That is going to have a huge effect in terms of pulling the rest of the market along with it. And again, you guys are really fortunate in that all of your lead partners understand the current landscape quite well. So if you're thinking, if you're Magic Block, right, and you're building in gaming and you want to supplement your understanding with what we see at the firm, like ask and we'll tell you and we can figure that out together. And Maggie, who leads our go-to-market efforts, almost certainly can get you an introduction to the best companies in the space. That's one example. We can pretty much universally apply that across the cohort. So think about this, ask us, and we're here to help. Number three, and closely related, is that, and this is generally true in all technology markets, and I'm betting that for those of you who are already in market, you've seen something like this. It turns out that in any segment, in any category, in any market, there's a set of users, customers, developers who are just like better and smarter than almost anyone operating in the space. And if you're able to, one, discern and understand who those people are, and two, listen to what their needs are and then build for them, similar to winning the best customers, if you build your product roadmap aligned with the smartest customers, what's going to happen is that by satisfying them, you're going to pull the whole rest of the market forward with them. Because again, the following customers want to do what the smartest people in the space are doing. And so if you've already solved their problems, you can get the rest of the market to come with you. Number four, so in the same way that we have this incredible set of primitives with tokens and being able to supercharge network effects, it also, it's not without challenges, right? And we've all seen this, which is that when you launch any new network and new protocol, there are a group of good actors, your power users, and there are a set of airdrop farmers who show up. They create like fake activity and congestion on the network just as a way of hoping you're going to give them like a little dollop of your token and they can like immediately sell it and make a quick buck. And so when you're designing reward systems, when you're doing airdrops, like you really want to take the time to figure out who's who, and you want to reward the good actors and isolate the bad actors. And I think that we're in the midst of a transition here where the market is getting more sophisticated about this. But like one thing that everybody used to look at on any new network was TVL. Like it turns out total value locked, right? That's like a really bad indicator of the health of the network and what's actually going on because people have gotten so good at gaming the system and producing fake activity and the like. So you want to get much more sophisticated at understanding who's using you and how, and really investing in the good ones and kicking out the bad ones. Last but not least, again, in a network and a protocol, you have often a token treasury. This is an incredibly powerful and valuable asset, and you want to make sure that you're deploying it wisely. So you're giving a grant, if you're incenting someone to build on top of you. One, you want to be able to track the progress of any project, right? So you want to make sure that people who you're working with, who you're partnering with, are actually doing what it is that they said they were going to do on the time frame that they said they were going to do it. And if you're giving them any kind of grants, right, what you don't want to do is pay this out all up front and then hope that they deliver. You want to make things milestone based so that as your partner makes progress, they're getting rewarded appropriately. And then perhaps most importantly, right, you want to, when you're assessing any kind of partnership, you want to make sure that the ultimate ROI that partnership is going to deliver back to you exceeds whatever the cost of it is. And I think that in the last bull run, we saw a number of projects, and you guys like all know who these are, who just would overpay to get big brand name logos, on their website, on their slides. But it turned out that those logos never ended up producing anything of value that people used or cared about. So it was all just like a big waste of time and money. So it's important to be discerning about who you're partnering with and make sure that what they do is actually going to bring value back to you and your network and your protocol. Another thing to think about, right, is that one reason that we wanted all of you in the cohort is that through the application and interview process, we all walked away very convinced that you guys deeply understand your respective markets and the products that you're building, and you're very native to the space. And what you don't want to do, and what we've seen in the past, right, is that the Web 2 and Web 3 markets could not be more different. The headline number, probably top and bottom of the slide, like Web 2, billions of users. Web 3, tens of thousands of users. At the bottom of the slide, any single individual user in Web 2 has a microscopic, if not negative, what's called ARPU, average revenue per user, versus like in Web 3, every person who's really engaging in the right way is unbelievably valuable to the network and the product and what they're building. And so like it stands to reason that if you took a Web 2 centric approach to finding product market fit and customer acquisition, like it's probably not going to work because the markets are so different. And what you don't want to do is like go down this road to nowhere where you use all these Web 2 tactics, you spend a lot of acquisition dollars, and you sort of end up with no valuable customers or users or behaviors at the end of the road. So we'll talk a lot about that and make sure that that you all are steering down the good path. So one question that I get asked all the time for people who are, maybe this is their first company as a founder and prior work experience has been in larger, more established companies where at least at some level things were working, like how are you going to know? How are you going to feel it? What are the signals that I'm onto product market fit? And what I would tell you is, I promise you, like you will know, you will feel it. And so what I thought I'd do is just share one example of a past company that I worked on, and kind of the moment that we knew that we were there. So I mentioned Loud Cloud, pioneering cloud computing. We were like a rocket ship upward, ran smack into the dot-com crash, 9/11, total financial meltdown. If any of you have read Ben Horowitz's book, The Hard Thing About Hard Things, he chronicles this journey really well. So Loud Cloud pivoted to an enterprise software company called Opsware, and what we did was took our software and turned it in, created a new category that at the time we called data center automation. Now, this is going to be hard for you guys to understand, but there was a time, like not that long ago, where if you were a company of any size and you had, and software was an important part of your business, like you had to buy your own servers, you had to buy your own storage, like, and I don't mean like rented on AWS. You like, bought these the server racks, you paid for power, you rented space, like you ran all this infrastructure on your own. And for a very, very long time, the way that you would manage all that was completely manual. You'd have hundreds, if not thousands, of what were called system administrators, network engineers, storage engineers that were running all this IT infrastructure. And so the vision and capability of Loud Cloud was we had the first automation software that let software do a lot of these manual tasks. Now, trying to convince people in the wake of the dot-com crash that like you actually needed this was really freaking hard. We would go and talk to Global 2000 CIOs, and they would tell us, well, like, our number one priority is server consolidation. And we're like, well, what does that mean? They're like, well, we have like way too much IT infrastructure. Like, we don't think technology is important. Like, there's never going to be a lot of users. So really what we're trying to do is like take all the capacity we have and like reduce it and make it less. And we're like, that is insane. Like, no, like really the internet is a big thing. People are going to want to use it. And like for about 2 years from 2001 to 2003, nobody believed us. Nobody cared. We got like a few customers, and it was really freaking hard because like we had gone public as Loud Cloud and stayed public as Opsware, so we had to do quarterly reporting, and so you like go to the street, announce your numbers. Well, we have like $1 million in revenue. Like we have $1 million too. Like you get punished in your earnings reports if you're not growing. Like the stock tanks, you're going to get delisted from the Nasdaq. Like all that stuff happened to us. And then like one day something changed, which was how many people have heard of a company called Enron? Right. So pre FTX, like Enron was a big financial disaster. Right. So this big celebrated public company Enron collapses, implodes. Everybody loses all their money, and so Congress in the U.S. passes a law called Sarbanes-Oxley, which is supposed to protect consumers from ever investing in a company like Enron again. And one tiny provision of the law was that every public company needed to do regular audits of their IT infrastructure. And lo and behold, we had built everything that you needed to be able to like do audit and compliance on all of your IT infrastructure. And so suddenly, after no one wanting anything to do with us, and not understanding what we were doing, like our phone starts ringing off the hook. Our sales pipeline, not the deals that we closed, but the prospects that we had went from about $1 million a quarter to $15 million a quarter in about 3 weeks. So like we were off to the races. It was amazing. It was happening. We thought we were great. There was one problem, which is the name on the right side of the slide. There was this tiny competitor that we hadn't been paying any attention to and weren't really tracking, called Blade Logic. They'd figured this out a little bit ahead of us, and so I remember this very well. It was like the third quarter of 2003, so like roughly September of 2003. We had, for the first time in our history, 4 $1 million deals in our pipeline of Fortune 500 companies, and again, this was 2003. So $1 million deal was huge. Like these did not come along very often in the technology industry, And we're like, this is going to be great. We're going to close them. We're going to be off to the races. And we ended up going 0 for 4 on all those deals. Blade Logic won every frickin' single one. And it was like, like the last day of the quarter was, it felt like someone had died in our office, and it was really painful. But we learned from the experience, we licked our wounds, and we then spent the next 2 quarters figuring out what our gaps were versus Blade Logic, how to beat them in the sales process, and we were able to, over the next couple of years, take our win rate against them from literally 0% to like over 98%. Like it got to the point where if we'd see them in another deal, we would get excited because we knew how to win. And all throughout this time, right, our sales pipeline kept growing, our customer list kept growing. That's what product market fit feels like. And what I'm so excited for is like all of you are going to get to know what that feels like, I think, over the course of the next months and quarters, and we're excited to work with you on it. So it turns out that, that was one example. I could tell you a lot more. I will tell you one more in just a minute. It turns out that that when you're trying to get from where you are today to the other side, it can be a little bit stressful, right? Because the future and success of your company, of your enterprise, of your employees hangs in the balance of you being able to do this well. And so it can really mess with your brain. The way that I would describe what it feels like, this is a picture of me in the forest, blindfolded, on my knees, trying to find a rare mushroom, just like sort of wandering around on the ground, trying to put my hands on it. And it turns out that, if you're looking at the screen, it's blank. Like you can't see anything. Like you're literally wandering around trying to figure, like that's what finding product market fit often feels like, because until you get there, you haven't gotten there, and so you're trying all kinds of things. The good news is that once you get there, it feels like you've entered the land of rainbows, kittens, unicorns, and butterflies, because it's at that point like everything in your company just starts to work, right? All the executives that you have thought about hiring, like there's now a reason to do it, and you can like put them to work on doing good things. You can all your numbers start going up. Your dashboards go from permanent state of permanent red to green. It feels amazing, and I would say to me the high as a founder, as an entrepreneur, that you get from cracking this code, unlocking this is just, it is the best thing. And so I just wanted to conclude with another story about my last company called Lytro, to try and help land the point of like what this can feel like. And my wish for all of you is that the journey that you're going to navigate isn't as hard as this one was. So just to set the stage, so Lytro, computational photography company, the big innovation and technical breakthrough that we had is that if you go back to the invention of photography, which happened in 1850, all the way up to today, if you think of an image sensor in any camera, it doesn't matter if it's like an iPhone or the highest end cinema camera, they're only able to capture 2 properties of light. They can capture brightness and color. And what we'd invented at Lytro was the ability to add a third dimension of data to every image. Didn't matter if it was a still picture or video. We were able to tell spatially where in physical space, in 3D space, every single picture in a given image was, which it turns out has like just breakthrough capabilities for photography, for visual effects in movies, for augmented and virtual reality, for self-driving cars. Because again, if you can essentially have depth data about your image, you can now do all kinds of amazing things. At its heart, Lytro was really what you would consider a true Moore's Law technology, meaning that the more compute, data, and storage that you threw at the problem, the exponentially better results you could get from it. The challenge was that I joined the company to take over from the founder who had started the company out of academia and wanted to go back to academia. So I came in when the company had shipped its first product, which is what you see on the screen there. And the problem was the company had started in probably the worst possible place in the market you could, which was to build a consumer handheld product, right? So, not very Moore's law friendly, very price sensitive, and the first product shipped in 2011. Right as smartphone photography was just going exponential, and the entire rest of the camera industry was like absolutely dying. And so my job, I came in to figure out, was there a place that we could take this tech to still take advantage of what it had to offer. And so we looked at everything from microscopy to self-driving cars, which were like still really nascent at the time, and really like scoured every aspect of imaging. And what we found over time was that we had this breakthrough opportunity in the highest end of the market. So, could not be further away from where we started, which was building a product that met the needs of professional cinematographers and visual effects artists. And what we ended up building was this. You can see there's like a little bit of a difference in scale between the first product and the second product. And so, we were meeting with and talking to if you watch the most recent Academy Awards, like everybody that was there, Christopher Nolan, J.J. Abrams, Steven Spielberg, and the way that we knew that this was probably a good place for us to focus is that we would go into these conversations and start to tell them about how we could change their workflow, some of the capabilities that we thought we could unlock for them. And before we even got 3 sentences into it, they would start completing our sentences for us. They knew when we would describe a problem, they're like, oh yeah, no, I know that. Like we've been there before. If we had a system that could give us depth data, if it could do this, we would completely change our workflow. So we knew we were onto something, and focused the entire company on building this new product. I wish that was the end of the story, but the challenge was that we had, at this point, no capital to be able to do this. So when I joined the company, I'd been told by the board that we had about a 12-month runway, and that they would be supportive, and that we'd need to raise capital along the way, but they were there for us. So I quit my cushy job in private equity, jump in with both feet, and as I get in there and start like really digging into the financials, it turns out we don't have 12 months of capital. We have like 6 weeks, and the problem was that all the cash that we had been contractually committed to build that fucking little camera up at the top. So we had thousands of those things that nobody wanted and we couldn't sell, but we had like no money to go and build the new thing. So I embark on this emergency fund raising process, and I remember a board member telling me, who was like a well-respected venture capitalist at the time. He's like, look, the way this works is like, you talk to between 8 and 12 investors. If you don't get a yes, like that just means the market's not interested. It's not happening for you. So he's like, do your best, and we'll see what happens. I guess I didn't share my fun fact before. My fun fact is that no matter what I do in life, once I commit, I am committed. I'm not going to give up on it. It doesn't matter if it's like a project with my kids or something athletic, or running a company, but I was like freaking committed, and I was not going to let this thing die. So he gave the 8 to 12 investor guidance. 83 no's later, I got to Andreessen Horowitz and got a yes. And so they, A16Z, they'd had some money in the company before, but they were really the ones that let us that invested and let us take Lytro forward. So we didn't get to build a once in a generation technology franchise company. The challenge was that even though we got a pretty good first prototype, we needed about $200 to $300 million more to do all the custom hardware development that would have been needed to like really make this the industry standard. But we definitely got the attention and interest of Apple, Google, Meta, and other companies that at the time were super interested in being on the bleeding edge of imaging. And so we sold the company to Google. Like almost all the employees came over. Many of them are still there today. And if you look at Google's camera products, like particularly the Pixel phone, a lot of the core concepts and science that we'd built over here are the features that people like. If you've ever used Night Sight or some of the cinematic video stuff, that was all invented by the Lytro team, and we had like a good journey and ride there. During the course of this, there were many nights where I would wake up at 3 a.m. and thought that somebody was stabbing me in the chest, and it was horrible. But what I learned, and so that may happen to you. I hope it doesn't. But just know that if it does, you're not alone, and we're always here to talk to you and counsel you through it. But the two things that I took away from that I wanted to share with you. So number one is that often in this journey, like the ultimate destination, the outcome is outside of your control. There are going to be factors at play. Maybe you're building something that's just too early for the market. Maybe you haven't figured out the right product yet. So what you want to focus on is not the destination, but just asking yourself, like, am I doing everything that I can to make the best decisions possible and like get to where we're going? And then the second thing that I really took away from the experience, and I promise all of you will as well as part of this journey, is like what you're going to find is while it may be hard, once you come out of this, wherever you may end up, like almost everything in life that you might have thought was hard before is going to seem so easy. So you're gonna develop a skill set that I would say less than 0.1% of the global population has. And so I think that in itself is something that you should feel good about and take pride of. And we're honored to be on this journey along with you guys. And so how do you take the set of things that I just talked about and actually put it into practice? Well, it turns out that it's actually pretty easy. So one is, what are your current core beliefs about what it is that you need to do to find product market fit? If you haven't thought about that, you definitely want to take some quality time to think that through. Second is you want to turn those beliefs into a set of actions that you can take. So what are all the levers you can pull and experiments that you can run that will tell you if your hypothesis is on track or not? And then it turns out that your co-founders and actually other people in the cohort, this is why we do group check-ins, are almost certainly going to expand your thinking on the topic. You're gonna uncover new directions and ideas that maybe you hadn't thought of before by talking to all the other smart people in the room. And last but not least, like, look, I'm here for you. We're here for you. If this is something you want to work on or you're worried about, come talk to us because we will dive right in with you. Thank you all for listening. Let me open it up for questions.
Do you still have one of those little fucking handheld cameras?
Oh yeah, I've got more of them than you can shake a stick at.
Was there ever a point in your journey where you were just ready to give up? You're like, this is not going to happen. It's out of my hands. I've put in 100% and just I'm going to let this die?
I mean, like every day for a number of years. So there was a point where it was so miserable where I mean, like I was married with two young kids. Now I have two bigger kids, still married. But I mean, there were times where I remember saying to my wife, if someone offered me the opportunity to pay them $1 million, which we didn't have, and that would let me quit, I would do it in a heartbeat. But that opportunity didn't present itself, so we kept going. But I mean, part of it, right? And I think you guys will all experience this. Like when you're, I mean, as a founder and a CEO, not only are you committed to what you're doing, but you also have a responsibility to everybody else that you've convinced to come along with you on the journey. And at least in my experience, like you want to do right by those people. So like until you've exhausted every avenue, tried everything, like you just don't want to give up.
Suppose you found PMF with one of your products, but then you extrapolate and think that the market, even if you're the most successful, the market isn't that big, and you spot another opportunity for like a different product. What do you do? Do you keep building those two products in parallel, or do you just like go all in on the bigger opportunity?
Yeah, so that is an outstanding question. Actually, Maggie and I gave a talk on that at our last CSX cohort, and I actually think that the biggest failure is the wrong word, but the biggest disappointment is you're going to put so much effort and energy into what you're building that you want to make sure that what you're building for, like the theoretical destination or end market, however you want to think about it, is large enough that it makes sense to do that. So I would say that if if you're onto something, but you're pretty convinced that it's just not the end result is not going to be that exciting, and you've identified something that's maybe a little less proven, but you think represents a much larger opportunity, by all means, like go after the bigger opportunity.
So throughout the journey, you might have run some experiments to validate the product market fit. You might have strong beliefs about whether you have it or not. And at some point, I guess until you close that $1 million deal, you might start wondering, do I really have product market fit? Should I pivot? Like, I guess the question of grit versus quit. And I guess the answer is depends, but maybe you have some ways of navigating.
Yeah, so I think
that.
I mean what you want to be looking for are signals along the way, right? So there's not $1 million deal. Is that because my product's not good enough? The customers don't exist yet. I'm not articulating the need well enough. You really want to. I mean, this I think is maybe the most important thing to deeply understand is that oftentimes if you do a surface analysis of, actually, here's like a perfect example. There's a founder in our portfolio I work closely with, and they're actually going to be here in a couple weeks, and they'll maybe tell the story. But they said, look, we shipped all these new features that we said we were going to ship. Our core North Star metric is number of active developers. Like those didn't go up. Does that mean that we built the wrong set of things? And the easy answer is no. But that's actually the wrong answer. What you want to ask is like, well, like first of all, if you go back to that win rate point, like maybe it's not about more developers. Maybe it's about understanding who the best developers are for your product, and did they like the features, like and appreciate the features that you ship. Maybe it's about maybe the key people who are like the most likely suspects to do what you're doing don't even know that you ship those features, or maybe you haven't explained them well enough so that they deeply understand like what the benefits of using them are. So that's why like you really want to play the role, I think, of a interrogator or detective of yourself, of your team, of your customer base, so you can actually get to the real truth. And actually, a funny analog in the same way I talked about how the power law applies both to venture capital and to product market fit. Jay and Liz can tell you this, but I mean the way that we think about making investment decisions is a very similar process. Like and Mark Andreessen has talked about this extensively on a number of podcasts. Like you're really trying to get to the ground truth on something, and so I'd say that's the best approach to figuring out where you are in the process.
How does the journey to product market fit look different when you're working in an existing and well-defined market versus creating a new market?
For most technology companies, the best ones are almost always creating a new market, right? Because if the market was clear and well defined, there's a ton of incumbents who are pretty entrenched and are probably going to be able to effectively block you from selling into it. And so, like one of the best venture pitches of all time was when Stripe first went to raise money, like one of the things they said up front is that most of the companies for our product don't yet exist, and that's because they were building a payments product for online native merchants, and like not a huge number of them had come into existence in roughly 2009 when they were raising. And so I think it's I guess to directly answer your question, so if you're selling into a well-defined existing market, you need to figure out really a strong disruption strategy where what you're building is so different, so new, so much better that it'll make people consider an alternative to what they're already using. When you're building for a new market, it's all white space, but it's a challenging process of finding. I mean, it really comes back to the definition of product market fit. You need to find how in this new market you can build a set of capabilities that are going to intersect with a set of needs that people may not even know they have.
I have a very concrete question that goes back to your experience and also mine. I saw that you were a VP for subscription services at Google.
Yes.
Back when I was 10. One of the things I was really excited when I was working there, one of the products was Stadia. I'm wondering if you've been involved in that and if you can share a bit what has maybe not worked so well there or what the learnings were.
Oh man, yeah. So I did. I took over Stadia after it was no longer working, and we needed to figure out what to do with that. So for those who don't, so Stadia was Google's basically streaming video game service, AAA video game service. So instead of having to purchase and download titles, through a browser, I guess now both Sony and Microsoft have competitive products. But at the time, the idea that you didn't have to do a big download install for a AAA game and could play like instantaneously right in your browser was like pretty amazing. Yeah, we should talk about that over lunch. That was a failure that rests like completely at Google's feet. Like that didn't have to happen, and they just approached the market in completely the wrong way. Like the tech was solid, the go-to-market was completely wrong, the value proposition was wrong. Yeah, so it worked, right, which was good.
I had a question. When you were moving from selling cameras to basically mainstream retail, to building a product that or at least looks extremely complex and selling to Google, Meta, that kind of companies, how did you? At what time in the process did you say, okay, I think we have product market fit because those companies are saying that we want use some kind of technology like that, and we don't necessarily want to develop or build that in house. But at what time I guess it goes simultaneously. When did you say, okay, like at this point, we're actually going to put in the capital to build this device such that we can serve our customers? And how did you manage that process in terms of timelines?
Yeah, sorry, that's a part of the story that I left out, which was that not only was like there the pivot and the capital raise, but when we decided to go to this new place, we had to lay off about 70% of the company because the people that we had who were great engineers and product managers that knew how to build consumer products just didn't know how to build a large-scale enterprise product like that. So that was yet another part of the trauma.
Yeah.
So I think it actually relates. I think Paul's question set that up well. We made the decision when we could see that we had interest in a new market and believed that was just fundamentally a bigger opportunity than the market that we were in.
And had you confirmed those deals with those companies before you actually?
Oh no! And we had nothing, right? I mean, it took us about 14 months to build the new product. So all we had was customer enthusiasm and confidence on our side that we knew what it would take to build a product that would work in that market.
Okay, thank you.
Yeah, so I mean, this is like one of the challenging parts is you are often taking a leap of faith into the unknown, and so that's part of what makes the psychological part of it so challenging.
Yeah, somewhat related question. So with Opsware and Lytro, it sounds like it took a few years to get to a clear PMF. Going back to the earlier talk, how did you keep filling up the gas tank to make it to that point in time? Like, what was the narrative was there, but what were some of the proof points you were using to raise the capital required to get to that clear, demonstrable PMF? And kind of, is it a specific type of investor that you need to find? Yeah, just some commentary on that.
Yeah, so I mean, there's a chapter about this in The Hard Thing About Hard Things. It's well told there. But the summary is that that part of the pivot was driven by the fact that we couldn't raise capital. So we started the company on September 9th, 1999, which was like peak fundraising for .com companies. Found ourselves public less than 2 years later with $100 million run rate, and then the entire bottom fell out of the market. First driven by the .com crash, then 9/11. And so part of the pivot to an enterprise software company was there was no possibility of getting new capital into the company, and so we needed to take the remaining funds that we had and move to something that was more capital efficient. Now, like you can argue, right? The things that we were building with Loud Cloud would have been indistinguishable from what AWS became. So there's a theoretical argument that had we somehow been able to keep the company capitalized for another 5-ish years, that we would have been better off staying as a cloud company. But that was not an option on the table at the time. So I think a lesson is that sometimes the circumstances and market will dictate moves that you have to make, even if you don't want to or they're suboptimal.
I got the last question. So you told a story that Opsware didn't have product market fit, and the situation changed because of an event with Enron. But that was something outside of your control that just sort of helped you achieve product market fit. The customer found you, not you finding the customer. And I just wonder whether that's, do you see that as an okay strategy, waiting for situations to change? Or I'd just like some commentary on that.
Yeah, so I would say, it's a little less binary than that. The way I describe it is the market conditions changed such that something that we could do became important, and we were, I think, through luck and experience, we're able to figure out that there was a there, and so we then really navigated the company towards that. And I think that the more general description of what you're describing, which I think is the hardest part of doing a technology company, is that timing is completely unpredictable, and it's not in your control. So there are definitely going to be times that you're building the right thing, but the market is just not ready for it yet. And then your job as a founder CEO is to figure out, okay, of the options available for me, and given what the market is ready for, how can I steer the product to take advantage of that, and then hope that over time the world realizes the full brilliance and beauty of what it is that I actually want to build.